Hello, this is Steve San Angelo once again from the SRS Rock Report, and I'm glad you're joining me today because this is going to be an interesting update on the gold investing, which most precious metal investors are interested in, and what really drives the market price. And I've done some new research, and in doing the research, I've actually been kind of fascinated what the results are. So I'm going to share that with you today. Now, if you've been following my work, you know that I've based the long-term price of gold over the last 100 years on the oil price. And it has, especially if we look at this chart. Now, I just updated this chart up to 2018. It shows the oil price in the black line, and then we have the gold price in the gold orange line. And as we can see in the 1970s, we had huge consumer price inflation. The oil price skyrocketed, and that impacted the gold price, the gold production cost as well. Then prices fell and remained in a trend in the 80s. And then back in 2000, we saw another huge increase in the oil price. And actually, both gold and oil peaked in that 2011-12 period. But while oil is a good indicator of price over a long period of time, I found that it's not a good indicator on a short period of time. And this next chart, or series of charts, show our quarterly basis. We have from the first quarter of 2015 to the third quarter of 2018. And here in the white line, we have the average gold price for that quarter. And these green bars, olive bars, show the oil price. And this is the West Texas US oil price. Now, when the oil price was falling, we did see a weakness in the gold price. But what's interesting, in the first quarter of 2016, when the oil price hit a low of $33.20, the gold price moved up. It didn't fall. It moved up 70-something dollars. You would think it would decline because the cost of production is less. Also, if you look at the last quarter of 2018, the third quarter, when the oil price hit almost $70, the gold price declined. And you would think the gold price would move up if the oil price is increasing because it's impacting the cost of production. But we don't see that. So there's something else going on. Now, what is the driver of the gold price here? Well, we have to look at the next chart. Now, these next few charts are information from the World Gold Council, and this is global gold ETF demand on a quarterly basis. Now, I'm not going to get into the debate on the manipulation of the global or the gold ETF market, the rigging of the gold ETF market, if the gold ETFs have all the physical gold in their inventories. I don't care. What I care about is looking how retail demand, which is gold ETF demand. We have to remember 99% of the market invests in stocks, bonds, and real estate. So they are the leading driver of price. 1% of the market purchasing physical gold or silver isn't the driver of price, and I'll show you in the next chart. But if we look at as the gold price weakened, we could see that we went from 26 tons, and these are metric tons, these numbers. We could see those gold flows into the gold ETFs, 26 tons, but over the next 3 quarters, we see it was actually outflows. And then we had a huge spike up in the first quarter of 2016. I will show you why. And so when we had increased demand for gold ETFs, the price increased. When it peaked and then declined in the fourth quarter 2016, we can see a big withdrawal, outflow, 173 tons. Then over the next year in 2017, kind of remained flat. The gold price didn't go anywhere. But what we could see here, when the gold price fell, we saw outflows of gold ETFs of 103 tons. So when the price of gold is increasing, we see the retail investors moving in. And when the price is falling, we see retail investors moving out. Now, it's the exact opposite with the physical gold buyers. And I didn't really understand how opposite it was until I looked at the data. Now, when the price of gold was falling, we see higher demand, and these are in the green bars. So when the price of gold fell from $13.35 down to $12.22, in the fourth quarter 2016, we had the highest quarterly demand in this 4-year period. And then again, when the price fell in the third quarter of 2018, we saw another spike up. It's the exact opposite of what global retail buyers are doing. So we can look at this information objectively, and to me, it shows that the retail gold paper buyer drives the price more than the physical buyer. The physical buyer, now this is private investment. This is not central bank gold included in this data. This is physical gold, coin, and bar demand. So what I see from looking at this information, that the gold buyers, the 1%, are taking advantage of low prices. When the price shoots up, their buying is pulled back. So until we have fear in the market, I don't think we're going to see a huge increase in physical gold buying. And I'll show you that in the next series of charts. But now another indicator, big major indicator of the gold price, is the broader market. And a good indicator of that is the Dow Jones Industrial Index. So these bars are the average Dow Jones Industrial Index average for each quarter. I got this information from the Federal Reserve data. So the blue lines are averages for the quarter. The red here is the low, and the green is the high of this last quarter. So what's interesting, when the Dow Jones sold off, and it started to sell off in the third quarter of 2015, it moved back up, and then it corrected again in the first quarter. This is, I believe, fear was coming into the market. I think investors thought the market was going to roll over. So that's why we had the big increase of retail buying of gold during those 2-3 quarters. But when the Dow didn't sell off and it made a new high in the fourth quarter, the gold price fell, and then the retail investors sold gold, and that impacted the price. And physical buyers bought more. So what's also interesting, when the Dow Jones hit a new record high of almost 27,000 in the third quarter, I believe that was in October, we could see the price fall. And the reason I believe the price fell had to do with there was so much bullish sentiment in the market, in the broader markets, there was just a lot less interest for gold. And so when the Dow was moving to new highs, there was less interest in gold, the gold price fell, and we saw the demand for global gold ETFs also decrease. Now, this next chart, series of charts on an annual basis. This is from 2007 to 2018. This is the global Brent oil price. It's a little bit more expensive than the US oil price, but they both trade up and down together. So what's interesting, we have the Brent oil price here, and we have the gold price here. Now, it is true that the oil price moved up, and so did the gold price. But when the oil price remained flat, the gold price started to decline. So something else was going on. And then right here, even though the oil price continued to fall, the gold prices remained in this flat 1,200, 1,250 range. And again, the reason I believe that's the case, and I've said this in my last video, has to do with the major cost of production support level. This is what it costs the gold mining industry now to produce gold, right here. And I showed you that from this chart. I repeat this, but it's important, especially for new people. This is Barrick and Newmont. They are the top 2 gold miners, and the orange bars are their production cost, and then the gold bars, or the green bars, are the gold market price. So in 2004, Barrick and Newmont, their cost of production was $366 on a $400 spot price. But in 2016, when the oil price was only $2 more than what it was in 2004, the cost of production was 3 times higher. Because of the falling ore grades and all the energy return on falling energy return on investment, it just costs so much more to produce gold. So this is why I believe this is a floor. However, what is going to impact the gold price? To me, the number one indicator is going to be what happens to global gold ETF demand. And that is the 99% of investors. And so we have two spikes in 2009 and in 2016. And the reason for that, I'll show you in a minute, was due to sell-offs in the market. But when gold ETF demand was strong, the price was moving up. When gold ETF demand declined, we had sell-offs, the gold price fell. And then when we had big demand in 2016, the price moved back up. But as we could see in the last few years, because the market has hit new highs, there's not a lot of interest in gold ETFs. Now, how about physical gold? This is physical gold, bar and coin, or on an annual basis. And yes, as we could see, after the big crisis, the housing and banking crisis in 2007-8, there was a lot more demand. Demand for physical gold increased as the price increased. And then it peaked in 2011. And as the price went to new highs, gold buyers pulled back. But here's what's fascinating. In 2013, when the gold price sold off $250, we had the highest amount of gold buying. Again, investors take advantage of the low gold price. But now, in the last 5 years, even though the gold price fell a little here, it's remained in this 1,200, 1,250 range. Gold buying, physical gold buying, has been flat. Even though we saw some changes in quarterly, on an annual basis, it's been between about 1,000 and 1,100 tons. And so it's going to take a big increase in the gold price to motivate the gold investors to start buying more gold when we start seeing a correction, a major correction in the market. Now, this next chart takes both the physical gold as well as the global gold ETFs, and it puts it together. And it's the net gold investment. So when you add both physical and the ETFs, this is how much investment there was. And it was very strong up till 2011. And it peaked when the price peaked. And then it started to just slowly decline in 2012. And in 2013, when the price fell, the net investment really dropped. And most of that was due to the sell-off, the outflows of retail gold. Now, as I mentioned, the gold physical buying has been about 1,000 tons for 5 years here. So this spike up was due to the global gold ETF demand, which pushed the price back up. Now, even though net investment has fallen, but it's still double, almost double than what it was in 2007, what we could see, the gold price remains in this floor. And again, that has to do with the production, the floor of the production price. So to conclude, I do believe the number one indicator to look in the future is what happens with the retail investor. The retail investor is the major driver, whether it's a small investor, whether it's the large speculator, whether it's the hedge fund, institutional investor. When they move into gold, paper gold, gold ETFs, they are the ones that are going to drive the price to new highs. And then we're going to see physical buying picked up. So now this chart shows you exactly the parallel between retail buying and the Dow Jones average. This here is the Dow Jones Industrial Average on an annual basis. The blue are averages, the red are the lows, and the green is the high for the year. So when the Dow Jones sold off, see, it fell almost in half from the year before. We had a huge spike in retail buying. Fear motivates buyers. And then when we had the gold price sell-off, when the Dow hit another record high in 2013, we had a major liquidation of gold ETFs. It wasn't until the market had another substantial correction that we had more interest from retail investors. Now, as the Dow Jones hit a record high, retail investors don't care about gold. But what is fascinating, when we only had about a 15% correction in 2016, we had 547 tons compared to when the market was falling to its low. What happens when the Dow Jones really falls? Now, this next chart shows you some of the important support and resistance levels. And technical analysis does play a major role in the market because this is what guides the prices. And 14,000 for the Dow was a major resistance level until it was broken in 2013. And then 18,000 on the Dow became a big resistance level until it was broken in 2016. And now look at where we're at now, 24,000. When the Dow hit a new high in the beginning of 2018, it's been selling off, even though it goes below it, and these are monthly tickers, even though it goes below it, it doesn't close below it. Went back up to a new high of 27,000 in October. Again, look at the volatility, and this is a major support level. Once this support level doesn't hold, we could see the Dow Jones fall back to this moving average and then back to the 1800. This is when I believe we're going to start seeing a lot more retail investment for gold. And that is what is going to be the major driver of price. Now, in 2007-8, when we had the big correction in the Dow Jones, you could see this is the relative strength index. It was overbought. When it's very overbought, it has to correct, and then it becomes oversold. And we see, even though in 2016 it was overbought here, it is very overbought here. So when we see a major correction in the Dow Jones, that is when we're going to see a huge increase in net gold investment. So when we start seeing getting back up to 14, 16, 1800 from this 1100, that is what's going to drive the gold price. And the major indicator or the major driver is going to be the retail gold ETF demand, whether we like it or not. So if we pay attention to what the retail investors are doing, when they start becoming fearful of continued falling asset prices in the stock market and real estate market, they're going to protect wealth in gold. And that is what is going to drive the price higher. And it's going to motivate physical gold buying to increase. So I wanted to thank you for watching this video. I think the analysis does show that there's a big difference between the retail investor and the physical gold investor. I do believe when the markets do correct in a big way, we will see both investors move in, and that's what's going to push the price higher. So if you haven't already subscribed to the SRS Rocco YouTube channel, please do so. And also, if you'd like to support the work, you could do so by going to the website, and you can do it through PayPal or Patreon. Well, thank you very much.